All right, folks. Now coming into the week, also my next guest said that stagflation fears, you've been hearing a lot about that they're overblown. Want to bring in another Wall Street legend, Cresset CIO, also founding partner Jack Ablin. Jack, so you're not seeing you're not seeing all the damage to the financial markets when there is stagflation necessarily. We've got some of your bullets up here, but before we get to this, how does a stagflationary market look? Like, what are the signs that we'd be looking for?
Yeah, so a stagflationary market is really the worst of everything. We get a recession with, high inflation, as we had in the early 70s, and the Fed is stuck. Do they want to attack the recession and try to bring rates down, but could fuel more inflation, or do they sit tight and make the recession worse? So it's really the worst of all possible scenarios, one that certainly investors are worried about, but also I think those fears are, as you said, are overblown.
Coming into the week, though, crude was going higher, equities, trillions of dollars being erased, money coming out of emerging markets, treasury yields up slightly, gold down a little bit. It just felt like there was no place to hide coming into the week.
Yeah, that's it. I mean, that's, when you think about stagflation, there really are no places to hide in an environment like that. And that's really what prompted me to start looking at this a little more closely. When you dial back to previous energy crises, high oil prices always translated to higher inflation. The good news is our economy has evolved, our labor market has evolved, and technology has really driven a lot of it. And the linkage now between high energy prices, high oil in particular, and inflation is largely disconnected, thankfully.
It's interesting that, and we've got, you have four key arguments why this time is different. No wage price spiral, economy far less energy intensive, like maybe 1.5%, 2% of GDP. Demand was already softening. It feels though like the economic backdrop in your mind was beginning to deteriorate just a little bit.
Yeah, that's it. I mean, I just saw Ed. I'm a big fan of Ed Yardeni. I happen to see your conversation, and I would agree. We did raise our recession probability from 20% to 25%, so we're still a little bit behind where Ed is. But we, are somewhat concerned that the high oil prices will actually start to crimp spending away from discretionary, and that could really start to push things down. But right now, we're not there yet. And if we see an environment like that, then I would argue that intermediate and longer-term bonds are probably a good deal in here.
All right, we've got less than a minute and a half to go through three ideas. Cardinal Health is one. You're really big on dividends. The dividend yield and growth on this aren't as robust as you normally give to us.
No, the deal here, Charles, is really cash flow. This is a high cash flow business, a lot of cash to enterprise value. So it's a great cash engine and one that can drive dividends going forward. And what we will likely see is that dividend growth go up here.
All right, let's talk about General Dynamics. I think everyone's trying to get these kind of names in their portfolio now. This is more like
self-explanatory. Yeah, self-explanatory. Again, not a huge dividend, but dividend growth in excess of inflation, and strong cash flow generator as well. Very high quality company.
Right.
And then the last one is, if we're trying to move away from AI, and most of these names are not engaged in AI directly, would be Kenvue. Kenvue is really healthcare and consumer products. Right now, AI isn't going to replace notions, potions, and lotions.
It's not, but are you concerned about that dip late last year? This is a pretty ugly move down to the downside.
It was. So there is this tug of war, if you will, between what I'll call digital and analog, and this is clearly an analog play. I think that when everyone thought that digital was, just going to take over the world, that they left a lot of the analog, a lot of the real hard good stuff for dead. But I think now there's a balance, and I think investors realize that we need both.
All right. Hey, great stuff. Great conversation, Jack. Thank you very much. Appreciate it.
Thank you, Charles.